Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Bryan Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Joining us now in our studios in Hong Kong is Jill Disis, Bloomberg's China EcoGov Editor. So a little bit of a mixed bag there on data. I mean, the manufacturing numbers, that's good. People will definitely take some heart from that. And we had some pretty good export numbers earlier last month. But the property data still kind of hangs there looming large at the moment, doesn't it?
Yes, Brian. So I think what you're ultimately looking at here is kind of a two-track economy. You've got on the one hand the industrial sector, which is doing better than expected. We saw that really positive industrial output data for the first 2 months of the year that followed some really encouraging signs on export, indicating that foreign demand has really picked up. Obviously, this latest PMI survey on manufacturing, snapping that 5-month streak of declines, adding to that idea that the industrial sector is actually probably at this point seems to be one of those major drivers for the Chinese economy this year. On the other hand, though, those really worrying property sector numbers, this idea that home sales aren't picking up, it really points to ongoing challenges with domestic demand. I know that we saw that CPI gauge tick positive in February, but overall the trend is still deflationary, and so that does indicate that there are concerns on that side of the equation.
I want to get your take on an interesting development last week, and it was Xi Jinping's comments about monetary policy tools at the PBOC. And it sounded like he was talking about getting behind a kind of quantitative easing, because he talked about how, the PBOC had these tools and that they should be increasing buying and selling of government bonds. I'm not sure it went anywhere, but what did you make of that?
Yeah, I think this is actually something that we've kind of seen the government hint at least in fairly recent months. So ultimately, obviously, as you know, China does not favor quantitative easing historically whatsoever. But we have seen at least some efforts to diversify the ways in which the central bank has actually tried to help the economy. I mean, as we saw last year, broader rate cuts really didn't move the needle whatsoever. It didn't really do a ton to support the economy. But what the central bank has been doing is using more targeted forms of stimulus. So there's one in particular. It's a program that involves sort of special lending, so pumping low-cost central bank funding in phases into different programs to help with affordable housing and things like that. I think that that's the kind of thing that you might see the government do more of. We've seen a couple of those types of sales take place in December and January at the very least. So I think Xi's comments point to maybe further encouragement for the for the central bank to take a look at alternative forms of easing to kind of attempt to get things going again.
So, yeah, that's one of the key areas, is to try to get consumers spending, and housing is such a big part of everyone's total wealth in their consideration of how to spend, what to spend on. I'm curious whether or not there are other tools that they have that might help lift domestic spending, and whether or not more can be coming.
Well, so I think outside of just the central bank, because I mean, there's certain tools that they have, obviously, that we've been discussing. The government has indicated that they're interested in other types of support. So there's obviously on the fiscal side, they want to sell more sovereign debt this year. This is it sort of comes from this idea of the local governments obviously being incredibly indebted. Maybe that they can lean on the central government a little bit more to sell debt to fund infrastructure spending, which again, one of those really prominent historical measures to try to boost activity. But there's also, I think, some policies being discussed about how to help the consumer more. There's like trade-in, like buyback programs that the government has been discussing. So this idea of trade in your old goods for better ones, maybe try to stimulate some more demand that way. So there are sort of these piecemeal things that the government has been discussing, both from that fiscal side and then also from the monetary policy side. I think it's just a matter of whether that's actually going to sort of evolve into anything substantial potential this year to help, put the floor under this property sector slide and really get domestic spending going again.
We did see consumer prices actually rise for the first time in quite a while, almost half a year. And that might seem to indicate that if consumer prices are going up, that there's a little bit more appetite. Are there very many examples of spending, consumer spending, that might be encouraging?
Yeah, Brian, I'm pretty skeptical of that February CPI uptick. I think that the thing that you have to remember is that was also the month in which the Lunar New Year holiday took place this year. It was much later than usual. So I think that at least some of that uptick in CPI data is capturing spending over the holiday. We saw some more nitty-gritty numbers that actually looked at how, even though the broader tourism spending numbers were up for the period, per capita spending, so spending per person per tourist was actually lower than it was before the pandemic. So I think I would need to see better data for March, April, May, showing a more sustained, confident turn out of deflation than we're seeing right now to actually think, okay, that's we've snapped that deflationary streak.
And something else that might be more long-term oriented than short-term is the government trying to attract foreign investment back into the country. Are we seeing much progress there?
Yeah, I mean, look, 2023 was an absolutely terrible year for foreign investment, as we all know. We know that the government is trying to, boost things again this year. I think that, just last week, with a couple of prominent forums, we saw more higher profile leaders actually talking to foreign business executives, trying to convince them to invest in China right now. I think that, it's sort of this is another thing where there's a kind of a two-track issue here. Now, obviously, China wants to encourage more foreign investment. I do think that they're taking stronger steps this year to make that actually happen. But at the same time, China's also facing a lot of major geopolitical pressures that might make that very difficult. You've got all of these U.S.-led sanctions that are really kind of crimping the ability for China to actually attract, other foreign businesses, or at least limit the fields in which they can actually operate.
One of the big events last week was the Development Forum in Shanghai, and President Xi did get a chance to talk to a lot of top U.S. business leaders. And one of the core messages was that, look, China's economy is okay. So my question to you is, what does he know that we don't know? Okay. Or was that just a PR exercise?
I mean, I think that to a certain extent, he's, just even the fact that he's meeting with these business executives is, I think, a really big, it's a big deal, right? Because I think that shows that he wants to personally sort of, tell them, look, it's fine to invest in China. I do think that he's right from the perspective of, some of this really promising industrial data that we've been discussing does seem to help, indicate that maybe they can hit that growth target of about 5% that they've set for themselves this year. But really, the China story is much more about long-term economic growth drivers. How do you replace property as a major driver of the economy with things like EV sales, advanced tech, that kind of thing? And that's where I think the picture is a lot murkier, because while China has the capacity to, really boost those things, I mean, we've seen how much they've really built electric vehicles is really, big and big for global demand. But when you've got a lot of those geopolitical pressures, this idea of sanctions or restrictions on their business, are they able to actually keep that up and really transform the economy in the way they need to?
All right, Jill, out of time, but thank you very much. So much more to talk about. For instance, Wang Yi talked about how the economy was facing bewildering levels of trade curbs, and it's not likely that that is going to change anytime soon. We'll save that for another discussion. Jill Disis, Bloomberg China EcoGov Editor. Joining us for some discussion about markets is Paul Dobson, Bloomberg Executive Editor for Asia Markets, with us live. So, Paul, it seems like the Fed is intent here on preaching patience. Even Jay Powell, the last time he spoke after the latest Fed meeting, he talked about getting inflation down to target in time. So it seems like no rush to cut rates and no real rush to get inflation to the target.
Yeah. Good morning. And I think that's right. But I think that the flip side of that is that the Fed is still talking about cutting rates and being minded to do that at some point in the future. And in a way, the market seems a little bit untroubled at the moment about the exact timing, so long as it knows that the trajectory in the end is going to be downward for interest rates. And so I suspect that the market will be reasonably happy. The PCE figure didn't give us any negative surprises, and will take comfort more from the fact that while the Fed and Powell are preaching patience, they're still looking to cut later in the year, and still potentially going to be cutting 3 times based on what the dot plot tells us.
Yeah, in that clip that we heard from Jerome Powell, he talked about how strong jobs are. And you might think that with inflation high and the Fed still talking about cutting 3 times this year, that it is thinking more about employment, worrying that perhaps, the lagged effect of higher rates could impact the jobs market. So it's a little interesting to hear him talk about jobs being so strong, don't you think?
Yeah. I think that's right. But I think again, the turn it on its head, and the fact that he's starting to talk about jobs gives you one, the idea that the Fed is looking around for other reasons why it might need to cut interest rates later in the year. Again, giving us that sort of insight into the mindset there, and also the fact is that they are slightly worried about it and pointing that spotlight on it. So yes, things all look good at the moment, but it's kind of that 6-month out view again of where we could be headed from here.
Well, you have an inverted yield curve and a lot of other signs that something could bring us to the downside. At the moment, the markets are pretty focused on this idea that jobs are healthy, it's keeping people spending, they're reasonably content, and inflation is receding, and so it's good to stay long these markets, even if to some people, there's a little bit of frothiness there. So I raised this question with an earlier guest about what might the catalyst be for some disruption in this, because high valuations, often are not that sort of catalyst. Do you see anything out there that's particularly worrying?
There's always the unknown unknowns, but the known unknowns, the political tension that we have in the Middle East, for example, we know about those kinds of things already. Feels like the economy is starting to shift a little bit more upward globally as well right now. If you look at the trade figures coming out of our region, for example, you look at the Chinese PMIs that we just had, there's little out there immediately that would disrupt things. And I think that it's mainly that kind of confidence that sort of breeds that complacency, and that in a way starts to sow the seeds for a potential correction at some point in the future. Now, kind of the people are looking at the tech sector, talking in very excited terms. The earnings season seems to have been reasonably good, but it doesn't take too many bad reports coming out of that. How can people really monetize AI, for example, to give the market a little bit of a worry or a concern there. I think likewise, if you're looking for risks out there, the possibility that there may be more from the commercial real estate side coming through in the next 6 months, hurting bank balance sheets, still hasn't gone away really as a risk either. I think the third thing is, although corporate bond spreads are incredibly tight at the moment and looking very comfortable for issuers who are sort of eroding that kind of wall of refinancing that they needed to do this year, will the market continue to take that down, or will it start to get indigestion at some point in the year and start to raise those corporate borrowing costs again? Because if that's the case, then that could become a little bit more awkward for those companies that haven't got out there already into the market.
We've seen investors be pretty discerning in some ways because some of the money has come out of AMD and even NVIDIA off the highs, and Broadcom and others, and flowed into industrials and materials and financials, all of which in the past 4 to 6 weeks have outperformed tech, outperformed the Qs. And so you see that happening. And then I think for investors wanting to get out in front of that, they might be thinking about emerging markets and places that have had a little bit less attention. So I'm curious what you're seeing, any type of action in markets that might suggest money is flowing into EM, and if so, where?
Yeah. Europe and emerging markets, I would say, seems like, that diversification trade. If you really believe that things are good and going to continue strong, and notwithstanding the risk that we just talked about, are looking for value, then maybe you look beyond the US these days. So Europe would be the next obvious place to go. But yes, more money is flowing into... I didn't mention
Europe. The reason I didn't mention Europe is, you've got the DAX really at basically all-time highs, right? So it's already benefited.
Yeah, but the parts of Europe that aren't looking so strong at the moment, Southern Europe in particular, maybe. Also, the UK is suddenly back on investors' map as well. Not exactly an emerging market, although sometimes it's performed like that over the last few years. But I think for EM, it seems like people are looking for more active kind of asset allocations here, not just index following. Partly because they're still concerned about the drag that China has on that and some of the other emerging markets. But it's really about kind of looking for where those real pockets of exciting value are, and that might be in some of the cheap sectors, the financials, for example, or it might be some of the cyclical sectors. If we do believe that the PMIs are strengthening, the exports are strengthening, and we're seeing that uplift as well, and it might be kind of the old favourites like the AI stocks, particularly as in our part of the world, at least they pay a much stronger dividend than those in the US.
I wonder whether Australia might benefit here, and that it seems kind of symbolic with the wine tariffs adjusted by China. Whether or not that's a sign that relations between Australia and China get back on a more solid footing.
Yeah, and that would put Australia in a better position, particularly if we see an upswing in commodities demand as well, some more strength in the energy price complex too. Natural gas prices haven't been performing so strongly this winter in the Northern Hemisphere as previously, but nonetheless, if that makes a little bit of a comeback, that would also bode well. So I feel that you're right. Again, Australia not too far from those record highs already, but maybe more of the strength comes through on the currency side if we finally kind of feel a little bit more confident that the economy is on firm ground, even as inflation slows and the RBA starts to look at those interest rate cuts. I think from the currency side, though, it all comes back to the Fed and where we were talking at the start about that timing from Powell and his colleagues. And
finally, China, you mentioned that the PMIs were better, but we do have this drag from the property market. People want to see China deal with its debt, but then, how do you fix the property market without taking on more debt?
Yeah, and that's the drag, the lodestone around the neck at the moment. We had, kind of looking at the two columns where I put my news material preparing for our morning calls like this one, and there's lots in the good news column for China, but also as we have the banker news, we have the country garden news. There's still plenty weighing down on the currency sector. I mean, on the property sector. Still, yes.
I should get my hands on that list of good news and bad news because it's very important to us here as well. Paul, thank you. Paul Dobson, Bloomberg Executive Editor for Asia Markets. Our guest is Derek Izuel, who's a portfolio manager and chief investment manager at Shelton Capital Management. I see in the notes here some discussion of Japan, so we can talk a little bit about that. But let's first start with a couple of the big points of news that might be moving markets this week. The PCE prices data late last week in the U.S. and also the China PMIs, and hopefully we'll get to Japan. So I'm curious, it seems like the Fed now is moving a little bit more to a balance between its addressing of inflation and employment, those two mandates that they have, and it's more in balance. Do you feel comfortable with that, or do you think they should be focusing more on slaying the inflation dragon first?
Well, I do believe that the Fed actually is still focused on inflation. They're having a hard time getting the inflation level down to their target of 2%. It's seeming to settle long term around 3%. And so in that kind of situation, they're going to have to remain vigilant that at a 3% level, that it doesn't resurge back to 4 or 5 or 6%. So I believe here going forward, they're still going to be primarily focused on inflation for the time being.
And does that bring the longer part of the higher for longer mantra into play? When do you anticipate the Fed might take its foot off the brake?
Well, no, I think the Fed's got about 2 to 3 rate cuts left this year, but they're that's really about all we can hope for them. We were talking 6 cuts earlier this year. That wasn't really realistic. And in a world where the inflation level stabilizes at 3 or 4%, that's a very different investing environment than we have experienced for the last 20 or 25 years. So it's going to make a big difference particularly for U.S. investors, but also investors around the world and how they build their portfolios.
You see, the reason I mention the balance is, if inflation is too high and you really want to focus on inflation, why would you be cutting at all here unless you were concerned about the lagged effect and the possibility that with these higher interest rates for this long, that you would do a certain amount of damage to the economy and to jobs. And so that's why I bring in that they would be trying to balance it. In any case, if the interest rates start arriving before we get anywhere close to the 2% target, is that good for emerging markets? I mean, what would your target be then in that environment?
Higher interest rates good for emerging markets? Yeah, in general.
No.
Yes,
if they start cutting before we get to the target, which seems to be, where we're heading, and you even reinforce that, in that environment, what's a good target? Are emerging markets, for instance, one?
Yeah, I mean, if we do get more, I would say that when you're talking about emerging markets, that would be a good target. The key there is the dollar. And if we're looking at a situation where the Fed is starting to cutting rates, then that balance will then make the dollar less attractive than overseas currencies, particularly perhaps maybe Japanese yen, but any of these currencies. And when you get dollar weakness like that, that's really the key catalyst that emerging markets need to waken out of their long, 10, 15-year slumber. It was the weak dollar that really drove the last emerging market rally, in addition to China, but they were all related together. Back in the early aughts, which has been the last time that emerging markets have really delivered performance like we've seen in developed markets.
Well, it feels like a good moment to talk about the China thing. We had some pretty good PMI numbers, which suggests maybe we're turning a corner. We had some commentary also, though, from Ray Dalio saying, look, China's got to fix its debt problems or face a lost decade. What are your views on this?
I'd have to agree with Ray. We may see a bounce in here just because China has been so weak, at least in their investment markets, but certainly driven by combination of economic news as well as the behavior of the government. China's got three big problems. Debt is just one of them. I like to call them 3 Ds. Yes, private debt is a big problem for China, and it manifests itself in the real estate market. Also, on top of that, from a slightly longer horizon, is their demographics. They have the worst demographics of any large economy in the world. And it's all a result of the one-child policy they've had for a couple of decades. And as a result, that's not going to go away. And this is going to be a constant drag on their economy. Their population is actually even starting to roll over and go down. And then the third problem they have is when they came out of COVID in November of 22, everyone expected big things to happen. They expected a big surge in consumer spending. But all we really saw was a surge in production. And Chinese consumers really didn't spend much more money. And so they're now in a problem where they're in a deflationary situation and could get caught in a liquidity trap. So those 3 Ds are really weighing on China. But we could see an investment bounce right now in the short term.
Let's talk a little bit briefly here about the Bank of Japan and the yen. The Bank of Japan in scrapping YCC, but still buying bonds. It hasn't been good news for the yen. How do you see the yen moving, and can you take advantage over the next few months?
Well, yeah. So the yen obviously has been very weak over the last several months, and now they've released the yield curve control, which should help support the yen if we see somewhat higher rates in Japan. That the primary driver of the Japan-U.S. Exchange rate is the difference between their 10-year bonds. If you just look at that, you can throw in a little side kicker of oil prices and things, but the big driver.
All right, Derek. So, unfortunately, out of time, but love to have you back. Thanks very much for joining us. Derek Izuel from Shelton Capital Management. This is the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.